Yeah, well, welcome to ShareTreck. This is the evening video, 3:58. When I'm recording this, 3:58 p.m. Just thought I'd put out this quick video out there with my thoughts, because if you recollect, in the morning I had mentioned that some websites and some commentators are saying it's time to buy the dip. I do not think so, and this video is just going to gloss over some of the factors because of which I think this is not the time to buy the dip. Let's get started. So when would I recommend that you buy a dip? I would recommend that you buy a dip when I'm absolutely sure or reasonably sure that the bottom has been reached and now the only movement is going to be upwards. Or maybe I feel that at the most it might probably fall maybe 1 or 2% more before going up. Something in that ballpark. And that's when I would say probably it's now time for us to buy the dip. Whereas right now, the way some of the commentators are saying buy the dip seems to be a bit reckless in my personal opinion. And here is the reason why. You already know all the negative things that I have spoken about in terms of risks. Russia-Ukraine war, we don't have to go into it. All of you know very well what it is doing. So that leads to gas and wheat prices going up. You already know about that. I have talked about it for a very long time. Now, those two things, gas prices and wheat, are going to cause increase in all the essentials that people consume, and they have to continue buying those things in order to survive. Therefore, it's going to push us towards stagflation if the Russia-Ukraine crisis is not resolved quickly. That's the first point. And I don't see any efforts taking place at this point of time to finish the war. There seems to be no major initiative underway to go and do something out there and pressurize both Russia and Ukraine to finally cease hostilities and get back to normal and start producing wheat and gas for the next season. That's what they need to do right now. Okay, so that's one thing off the record. Second one, we already know the market was flush with funds. That's why we had a sugar high and the market reached its peak. And since then, the Fed has decided to increase the interest rate. So first they started with the interest rate hikes, and then they added the balance sheet size reduction also, which means not buying bonds, which means not buying mortgage-backed securities and stuff like that. So that mops up all the cash from the market. Therefore, there isn't enough cash available to put into the stock market. If the cash is available, people would rather pay off their loans because they don't want to pay high interest rates. And that's why we are finding ourselves in a bear market. Earlier, Europe had resisted raising interest rates. European Central Bank is governing a multitude of European countries, and they are in various stages of inflation. Some are facing very high two-digit inflation, while others have got low single-digit inflation. Finally, the ECB has now said that they're going to increase their rates by 25 basis points, and simultaneously they're also going to tighten their balance sheet, which means that the funds that were coming from Europe into US is also going to slow down, and it's going to freeze up. And also investments within Europe are going to have a tight money regime. And on top of that, they have this oil embargo that they need to establish before the end of the year, for which there's a whole lot of work going on. So Europe is in a very, very difficult position. This is on top of all the problems that we have so far. So I ask you honestly, which of these is going to get solved in a short term? If things don't get solved in the next 4 or 5 days, what is going to happen to anything that we buy when the market rises today? It's going to go down, and we're going to lose more money on it. So there is no way to say that we are already at the bottom. And that's why my original thesis of second and third quarter being consolidation and fourth quarter being bull is now out of the window. That's not going to happen. Things are going to look different. How different? I'm still working on a new model, and I'll share it with you once I have made up my mind on it. So having said that, we have even more problems that have surfaced very recently. The first problem is that the high interest rates and the tightening of the balance sheet by the Fed is causing a ripple effect in the housing market, both in US as well as in Canada. Here is a headline which says cooling housing market prompts layoffs at Redfin. So Redfin is a real estate company, and it will lay off 8% of its employees. Redfin has about 5,800 employees. not including those who work for RentPath, which Redfin acquired last year. Redfin's share price has dropped from about 39 at the start of the year to 8.55 this week. And the company lost 110 million last year, up from 18.5 million the year before, according to SEC filings. So this is one of the first headlines. The next headline I would like to show you here is US mortgage applications are in meltdown and the threat to house prices is growing, as economists says. So this has got some key points here. US mortgage applications are in meltdown, according to an economist, and the threat to house prices is growing. The Mortgage Bankers Association's index of applications tumbled again last week and has fallen dramatically since January. So if mortgage applications fall down, that means less people are looking to buy property. So those who already have a house and they find that they can't meet their expenses because of lack of purchasing power will not be able to sell their homes. They are going to be stuck and their wealth is going to be destroyed. Pantheon Macroeconomics said the chances of a short period of clear declines in home prices are growing. They are now starting slowly to warm up to the fact that home prices are going to decline. Basically, my point is that there is a housing crisis going on. And why is this important for us? It's important for us mainly because if housing prices go down, then people who own the houses will find their home equity line of credit shrink. And also with the increasing interest rates, they'll find it very, very difficult to dip into their home equity line of credit to make purchases. And at this point of time, we are not even talking about luxury purchases. I'm talking about essentials. And in order to do that, they would have to dip into their home equity line of credit. Therefore, it's going to contribute to lower sales for all companies. And when all companies have lower sales, they are going to have lower margins. And therefore, they will give a warning that their next quarter income is going to be below expectation. And therefore the share prices will go down further. So this is a vicious cycle in which we are likely to find ourselves because of a second wind coming from a fall in house prices, a fall in housing sales, and potentially foreclosures. All that is still yet to come, and it's not going to happen in the next 1 or 2 days, but it will unwind over the next 3 to 6 months because these things unwind slowly, and the amount of foreclosure applications that go into the process take around 3 months, I believe, before it comes to the market as a house for sale. So we have all these things that we have to keep in mind. Now let's go and have a quick look at what happened to BlueBird, because I have a point to make out there. Here we have the chart of BlueBird, and you can see day before yesterday I had mentioned that BlueBird is likely to give most of the gains. And the reason I said that is because what we had there was only opinion from the external advisory group of expert group of FDA that said that they are okay with Beticel. But it was not an FDA approval, and approval was going to come later. So the pre-market guys pushed it up all the way to 66%. I wonder what they were thinking. And then as expected, it fell down, but they had pushed it up so much, it had gapped up and gone up, and it fell down almost, I think, 50% or something. And therefore, there was a gain left of around 14%. So today, we have filled up the gap out here. You can see all gaps had to be filled, and we filled it up promptly on the way back. And we are at a negative minus 16.16% for BlueBird. Now, if you were to look at this whole price action out here, you would see that BlueBird was no better before the news as it is right now. So all the people who had this false notion that things are going to go up immediately, they have lost a lot of money out here. It's a huge loss. So I don't want any of us to get into this kind of a situation. It's better to be safe than sorry. See a good evidence of things moving up, and then we can probably start investing. That's the way I look at everything in general. So having said that, I'm just going to show you a few more things out here. Let's go to QQQ, which is in the indicators, and I'm going to go into QQQ just to show you how we have respected this line of support today. We mentioned that our line of support is going to be 273.52 for today, and we respected the line of support. We bounced off it, and we also tried to kind of respect this diagonal line of support, but it was too much. But still, we have some fundamentals in place. It's not total panic, and the drop is something similar to within the range of what we had yesterday, so not too much damage done. We went up a bit in the morning, and then we came down. Our MACD is bearish and momentum is flat and below average. So it's not looking great for going forward. And again, if you look at US oil, you will see that we have dropped below the diagonal line. And one of the reasons why US oil is likely to drop is also because slowly the oil producers will start realizing that there is not going to be much appetite, because even if people can't stop their consumption, there's a lot of areas in which oil use can be curtailed. People will drive less, factories will produce less as demand for highly priced commodities and everything goes up. And as a result, there will be less demand for oil. And therefore, it's in the interests of oil producers to bring down the price of oil in order to keep maintaining their market share. And that's the reason why there's going to be competition on the way down for oil in the very near future. And that's how oil will come back to normal. That's my opinion. And if we look at put-call ratio, put-call has come down to 1.14, which is still in the bear territory. It's come down. I was expecting it to start somewhere between these two lines, support and resistance, but things turned out to be much better than what I expected. We started up at the bottom and we went up and we closed somewhere up here, just with the support of the 9-day exponential moving average. So that said, let's have a quick look at the crypto sector, which is a kind of a train wreck. And if you look at Bitcoin, it has gone down to around 21,897. And I still think that we have some support at 20,233. If we fall below that, it's going to be really terrible for Bitcoin, because the next drop is going to be somewhere around 12,000. There's an $8,000 drop out there. And if we look at gold, gold has also lost value, and MACD is turned bearish, and momentum is also below average, so it doesn't look great for gold either. And I want to look at one of my favorites out here. I'm going to just show you a brief view of what's happening for the rest of the market. When people can thrash company like Amazon, which is doing a great business, which has got cloud assets, which has got retail assets, and multiple lines of income, that company is being beaten up severely. You can see it's at the very bottom right now. If you zoom out, each of these candles are one-day candle. It's at the very bottom. And also you look at Google. Google has also not done very well as such. It's just got a marginal gain out here. Even Apple is at as low as it has ever been. Under this kind of a situation, and in a situation where people are finding it difficult to pay for their essentials, and the housing prices are under pressure, mortgage rates are going up, mortgage applications are falling down. Across North America, we have this problem. We have this problem in Europe. In the midst of all these things, who is going to want to put money into risky genomic stock, right? It's all for die-hard followers of genomics like this community here and myself. We believe in genomics and we want to put money in there, and we want to see it grow. That is all in good. But if the rest of the market does not cooperate with us, if the rest of the market doesn't come and join us in this process, it's going to be difficult for genomic shares to rise. So I think we need to wait for the rest of the markets to pick up, and then people will start looking at places where they can invest to make more money. That's when we'll bring people who are not pure genomics fans, but who are looking for making money. Those are the people who will enter into the genomics sector, and that's the time when we'll see fantastic gains happening in our area. And with that, I would like to end this video. This is just a sanity check video. I would like to hear your comments. Now we have the community tab. You can start your own discussion out there, or you could put it in the comments. Give me your feedback on what you think is happening with the market, whether you agree with my thesis, and when do you think genomics will start picking up. Well, put your thoughts down there and let's have a discussion. If you like this video, please press a like there. And if you haven't subscribed, please subscribe and help us grow this channel. Thanks and have a great day. Bye for now.